Infosys, one of India's IT giants. But do you know the fact that financial services of the company contributes a lot more in revenue of the company as compared to the IT segment of the company? Also, is its current share price actually justified? In this video, we will use a proven financial model, CAPM, that is capital asset pricing model, along with the DCF, discounted cash flow method, to find the intrinsic value of Infosys and whether it's overvalued or undervalued in 2025. Let's break it down simply. Understanding of various segments in which the company operates is necessary to determine the risk involved in the operations of the company as well as the geographical challenges faced by the company, because there can be wars or different government laws and stuff that affects the company's operations in that country. If we look at the numbers of Infosys, we will find that a major part of revenue is formed by the financial services, and it is highly prevalent in North America. The company has a good global presence. CAPM estimates the expected return of a stock based on its risk premium compared to the market. The formula for calculating the cost of equity under CAPM is expected return equals to risk-free rate plus beta into market return less risk-free rate. So, risk-free rate is generally taken as the government bond yield or the treasury bill. For risk-free rate of India, government bonds are trading at 6.31% currently. The government bonds will be considered as the safest to invest, in which you are at most sure that you will receive the 6.31% returns. Now coming to the beta of Infosys. The beta of Infosys is calculated by comparing the standard deviations of the price movements, the returns of Infosys as well as Nifty. The formula for beta that we have taken is covariance of Infosys and Nifty divided by the variance of Nifty. It will give you the beta of Infosys, which comes to 1.38. The market return is the average return of Nifty or whichever index that you have chosen for valuation. In our case, Nifty 50. The return for last 6 years for Nifty has been averaged at 16.2%. Also, in the similar fashion, we can find out the required return, that is average return of Infosys in last 6 years, and that comes to 23.17%. Now, the CAPM cost of equity comes to 26.23% after calculating and considering the above data. Also, we will require the growth rate to find the estimated future cash flows of the firm. And for finding the growth rate, we will use the retention ratio, which we will get by calculating 1 minus DPR, that is dividend payout ratio, which is 66.7%. So retention ratio comes to 33.33%. Now, the growth rate is calculated by multiplying the retention ratio with the required rate of return, and the growth rate is derived at 12%. By using this growth rate, we will estimate the future cash flows of the firm for next 3 years, and after that, from 4th year and onwards, we will use a stable growth rate, which is estimated by the management of the company at 3%. To calculate the perpetual future cash flows, we will divide the estimated FCFF or fourth year by KE minus G, and then we will discount every year's FCFF by the discount factor of 24.61%. Now this discount factor is nothing but cost of equity, that is CAPM, multiplied by the weights of equity, and cost of debt multiplied by the weights of debt of the company. The total present value of all the future cash flows forms the value of the firm, which comes to 1,90,555 crore. Here we will net off the value of the debt and we will get the value of equity, which comes to 1,82,322 CR. Now this number will be divided by total number of equity shares issued by the company. Here we will get the value per share, which comes to rupees 439. Infosys currently trading more than 3 times of this value looks to be overvalued by valuation, though future growth may justify the premium. So according to CAPM and basic discounted cash flow method, Infosys might be slightly overvalued at the moment, but that's one lens. If you want more such deep dives into stock valuations, subscribe to Insight Equity, your stock market learning hub. Also, this video is for educational purposes and for referrals. The actual valuation of the company might differ from this, and valuation generally varies from person to person, as the valuation is majorly based on the judgments that the person takes for valuing the company.